President Donald Trump has once again escalated his long-running trade war, this time targeting one of America's closest allies and trading partners. In a move that sent shockwaves through the global economy, the administration announced a staggering 35% tariff on all goods imported from Canada. This policy decision, revealed in July 2025, marks a significant intensification of the protectionist measures that have defined Trump's presidency. The new tariff represents a dramatic increase from the previous 25% rate and signals a hardening stance against countries that the White House believes have engaged in unfair trade practices. The 35% tariff on Canadian goods is being implemented on top of several existing sectoral tariffs that have already strained commerce. For instance, Canada was already contending with punishing 50% tariffs on its steel and aluminum exports to the United States, along with a 25% tariff on automobiles. The official justification provided by the Trump administration for the 35% tariff on Canada was multifaceted, blending national security concerns with economic grievances. President Trump publicly cited the flow of fentanyl across the northern border as a primary reason for the punitive measure, linking the trade policy to the ongoing opioid crisis. However, he simultaneously voiced his frustration with Ottawa's own retaliatory duties. Initially, the administration announced that the sweeping new tariffs would take effect on August 1, 2025, a deadline that gave businesses very little time to prepare. However, as the August 1 deadline approached, it became clear that the logistical challenges were more significant than anticipated. The administration subsequently announced a short delay, pushing the effective date to August 7, 2025. The official reason given was to provide U.S. Customs and Border Protection with the necessary time to update its systems and procedures. While the 35% tariff on Canada captured most of the headlines, it was just one piece of a much larger global tariff overhaul announced by the Trump administration. Among the nations hit hardest was Switzerland, which was slapped with an even higher tariff rate of 39%. Meanwhile, Taiwan, a critical hub in the global technology supply chain, was hit with 20% duties, further disrupting the intricate network of electronics manufacturing and trade in Asia and beyond. Interestingly, amidst this wave of new tariffs, there were indications of potential exemptions for certain critical sectors. The Swiss government, for instance, received assurances that its vital pharmaceutical sector would likely be excluded from the 39% tariff. This exemption is crucial, as Swiss pharmaceutical companies are major suppliers to the U.S. market. The Trump administration's ambitious plan to impose a new global tariff regime on August 1, 2025, quickly ran into a wall of practical reality. The intricate machinery of international trade, managed by agencies like U.S. Customs and Border Protection, cannot be overhauled overnight. Implementing such a broad and sudden change requires significant adjustments to computer systems, regulatory codes, and inspection procedures that process millions of transactions daily. This new tariff regime represents a fundamental reversal of decades of U.S. trade policy, which had consistently moved toward globalization and the reduction of trade barriers. The administration's stated goal is to counteract the effects of this long-standing trend, which it blames for the decline of American manufacturing and the loss of factory jobs. As the Trump administration forged ahead with its tariff strategy, a significant legal challenge was mounting in the background, threatening to derail the entire policy. On May 28, 2025, a panel of judges at the U.S. Court of International Trade delivered a major blow to the White House, unanimously ruling that the IEEPA tariffs were illegal. This decision set the stage for a high-stakes legal showdown over the president's authority to impose such duties without congressional approval. Despite this lower court victory for tariff opponents, the administration immediately appealed the decision, sending the case to the U.S. Court of Appeals. In a crucial move that allowed the trade war to continue unabated, the appellate court decided to grant a temporary stay, permitting the IEEPA tariffs to remain in effect while it considered the case. The cumulative effect of President Trump's escalating trade war is now being felt not just in the United States, but across the entire global economy. The International Monetary Fund has revised its projections downward, estimating that the global economy will grow by only 3% this year. The economic data from the first half of 2025 reveals some troubling trends for the U.S. economy itself. The nation's trade imbalance, which the tariffs are meant to reduce, has actually worsened significantly. The trade deficit for the first 6 months of the year reached a staggering $582.7 billion. Beyond the trade balance, other key domestic economic indicators are also showing signs of weakness. The manufacturing sector, which was supposed to be a primary beneficiary of the tariffs, has instead begun to shed jobs. In another worrying sign, construction spending has dropped by 2.9%. One of the most direct and undeniable consequences of the ongoing trade war is the rising cost of goods for American families and businesses. The pinch is being felt across the economy, from the grocery store aisle to the factory floor. At the same time, businesses that depend on imported components are facing soaring costs, forcing them to either absorb the losses or pass the higher prices on to their customers. This reality on the ground directly contradicts one of the central claims made by the White House, that foreign countries would bear the cost of the tariffs. Economic data and numerous studies have consistently shown that it is U.S. businesses and consumers who are paying the price. This surge in the cost of imported goods demonstrates that the tariffs are functioning as a de facto tax on American consumption, making the trade war a kitchen table issue for millions of Americans who are feeling the direct impact on their personal finances. Despite the escalating trade tensions and the clear evidence of rising costs, the reaction from Wall Street has been more muted than one might expect. Financial analysts note that the effective tariff rate appears to be settling in a range of 15 to 20%. JP Morgan recently lowered its estimated risk of a recession from 60% down to 40%. However, this relative calm should not be mistaken for a belief that the trade war is over. The White House has already announced additional 25% tariffs on India, and Trump has promised new import taxes on pharmaceutical drugs and threatened to impose 100% tariffs on computer chips. This leaves the U.S. and global economies in a state of persistent uncertainty. The central question of whether this high-stakes gamble will strengthen the American economy or inflict lasting damage remains unanswered, with the world watching to see what comes next. The ongoing trade disputes could still escalate further, leading to more retaliation and deeper supply chain disruptions.